everyone, and welcome to the June edition of the Global Outlook video from the Economist Intelligence Unit. I'm Agathe Demarais, the Global Forecasting Director at EIU based in London. I'm joined today by Cailin Birch, EIU's Global Economist and lead US analyst, also based in London. And today we're going to discuss the US debt ceiling saga. So Cailin, a first scene-setting question for you. Where are we at to resolve the debt ceiling saga? And I should say here, we're in mid-May as we record this video.
Indeed, and things are changing rapidly. At the moment, we are getting down to the wire, really. So we have the rough outlines of a deal that are in place as of negotiations in the last couple of weeks. And that's a big step. The two parties still have a long way to go, but both have come closer towards a deal. For Democrats, they've backed down a little bit from their initial position, and they've effectively agreed to negotiate spending and the debt ceiling together. Previously, they wanted a firewall between those two issues, so that's a big concession of sorts. And they've also agreed to have unspent COVID funds being put back towards debt reduction in the potential outlines of an agreement. So these are two things they've previously said they wouldn't do. So showing signs they're willing to make a deal. Republicans on their side have dropped their wholesale opposition to raising the debt ceiling by being in talks, which we think was actually never that realistic. And they do appear willing, at least for now, to accept more moderate spending cuts than they would initially have demanded. So we're getting closer to the center, but several important sticking points do remain. Democrats want to protect, most importantly, their policy priorities, like renewable and other green incentives that were put in place under the Inflation Reduction Act, or to keep existing work requirements in place for food assistance, a key social safety net program. Republicans, however, also refuse to consider tax increases as a way of narrowing the deficit. And ultimately, the scope of spending cuts still hasn't been formally defined, so still a long way to go.
And actually, a key question is how much time do we have? Because we've seen various estimates of the date of a potential US default. How much time do you think we have?
I'd say it's probably something of a sliding scale. The Treasury Secretary, Janet Yellen, has said June 1st is the hard date. We think it's probably going to be shortly after that time. But all of that is much earlier than what people were thinking about a month ago when we had seen some estimates of July, perhaps even early August at a push. And now it is definitely going to be earlier than that. Now, the exact date will depend on the size of Treasury bills that come due in the coming weeks and months and how much tax revenue is collected. For now, we probably won't see much more of a grace period. We're actually looking at tax revenue in recent months that has been well below, about 25% below previous year levels. So I don't think that tax revenue in the next little while is going to expand that cushion. So more or less, we're probably looking at an X date that is sometime in the first half of June. And that adds a lot of symbolic importance to the June 1st date that Janet Yellen has mentioned, knowing, of course, that things are going to be very uncertain. We probably won't know the hard date when the Treasury runs out of cash until potentially a few days beforehand. So when do we need to start to worry? Is an important question. US markets have not been significantly affected so far. We've seen a widening of credit default swaps. Those are rising, implies a higher cost of insuring against a government default. And 1 month bond yields, so those that fall due around the X date of June, are also rising well above the target rate for the Fed funds rate. So all these show some little market jitters, but nothing huge. But I would say that crossing that June 1st threshold without a deal, even if the Treasury has funds to keep going for a few more days or potentially a couple of weeks, is enough to set off more negative effects.
Finally, one final question. How do things look like in a worst case and best case scenario? What ripple effects, what effects are we looking at?
So our core forecast is that we'll see a negotiated compromise at the last minute, basically just before the default deadline, and we're assuming that's around June 1st. That will have some negative effects on bond yields, which will rise for all maturities. I mentioned they've gone up for 1 month yields, but that will probably rise across the board. And the dollar will soften, of course, because demand for dollar-denominated securities will go down as uncertainty rises. Ultimately, though, those effects will probably be limited, both in their weight and how long they last, as long as that deal does get struck. And we do think that it will. But of course, those effects will start to magnify the longer the government goes past the June 1st deadline. And remembering in a worst case scenario that if the US were to cross the X date and effectively default, which is not what we expect, then definitely a year-on-year recession would be guaranteed. And that would be probably a difficult one to recover from. Neither party wants to be responsible for that outcome. So that's why, thankfully, it's not our core scenario.
Thanks so much, Cailin, and thanks to everyone for watching us today. See you next month. Goodbye.